What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is November 1st of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got a jam-packed macro episode where we're not only going to be talking about Bitcoin and the broader crypto market being at what I believe is a make-or-break moment here to continue the trend or to start reversing back to the downside, but on top of that, a macro event that could really help to drive the trend direction either way, and that's the upcoming FOMC meeting from the Federal Reserve, giving an outlook on monetary policy over the next couple of months going into the first half of 2024. It's going to give us a lot of perspective here on what we can expect for financial assets and their performance. I want to spend some time to break that down in today's video, and we're also going to be taking a look across the board in the stock market, looking for those early stage signs of potential recession coming up here in the near term. We've got a whole lot of things to cover here today. If you guys happen to enjoy it, consider dropping a like. It's a great way to support the free content we put out here in this channel. And let's go ahead and kick things off. So I want to start here by talking about Bitcoin, because I think Bitcoin really, above all the charts we're going to talk about, really is at a kind of catalyst point here, where essentially we've been able, with the recent rally, not only the recovery here from the general kind of earlier support range at 25K, but after clearing through the prior resistance range between 28K and 32K, we've been ranging here for about a week, coming up on this prior support line from the ascending channel. And the thing here we have to ask is whether or not trend direction is going to continue from here. If we've been able to temporarily make it a support, there's a chance for the bulls to show up here and drive up prices. But at the same time, it also could be just as easy here for the bears to knock down prices. Now, I don't want to sit here and just say, oh, I think it could go up or down. You all know where we stand. We do believe the prices are more likely to go down here. The key thing that I understand is that when we take a look back at the past year, all throughout 2023, we generally have these kind of sizable market order flow moves where there's some FOMO driving in prices off of some kind of narrative. In this case, it's the reaccelerated narrative of the Bitcoin ETF, and thereafter it just chops for a while. And I don't think we have that luxury this time around. We've either got to get bulls who come in here and continue to drive prices higher and really whipsaw higher with the ETF announcement, or we are going to see some of this start to cool down here. Now, putting that aside here, I want to go ahead and analyze the other crypto charts here real quickly, but then get towards the important topic. Here you can see for ETH BTC, we're continuing to see Ethereum and the broader altcoin space fade against Bitcoin, visiting some of the lowest levels here since back in April 2021. And this is really the case for all altcoins. Most altcoins are hit much harder than Ethereum here. But I think this is a really important sign here about the future risk-taking sentiment here. Even if markets start to move higher, you are not likely going to see altcoins leading here in the near term. Along with that as well, if you want to take a look at dollar terms, while we did get back into the ascending triangle, we are still, like the broader range of the altcoin market, setting in lower highs on each of these rallies after going towards lower lows or relative support ranges of the past. So we're not seeing some return to the norm here for altcoins. And while that's okay to see here in the early parts of the cycle, altcoins have gotten beaten down quite bad, and to see the continued weakening response here and not being able to even get past their prior dollar highs, even if they're not outpacing Bitcoin, that to me is a worrying sign here, because altcoins do make up a large portion of the market. To visualize this better here, we can see this on total 3, which excludes BTC and ETH, and we can see that including the total valuation of altcoins here, we're continuing to set in lower highs ever since back in May of 2022, more specifically during this kind of secondary wave after the first major capitulation from November of 2021 down here towards May of 2022. So we're not catching a bid yet, but at the same time, we are pressing up against resistance. The question is here, can we continue through here for the next couple of weeks and into the month of November? Time will tell. But we've got a big event here that I think is just as relevant here as a narrative of a Bitcoin ETF. And Bitcoin ETF could be a very big development for crypto. It could definitely bring more inflows into the space. And I think overall it would be a net positive event. We've never disparaged that here on this channel. While we do believe that there wasn't always a guarantee of an ETF, and outside of that, we do believe the inflows that people are expecting are way too optimistic. That all being said, it's going to be a positive event. But the question here remains how big of an event it's going to be. Because I think the bigger question here we got to ask ourselves is the general direction of the trend in liquidity. I'm talking about global liquidity here. I'm talking about the printing of new money or the removal of money from the monetary supply. Now, the big reason why I think this FOMC meeting is going to be such a big catalyst here is that the markets today are not expecting the Fed to make any substantial moves. And that might seem like a non-event here, right? If there's not going to be any changes here to the Fed funds rate, then why would people care about it? Well, we've seen that some of the biggest moves come from either the FOMC meetings or during the speeches at Jackson Hole that happen on an annualized basis, where the Fed really comes out and so much doesn't take action on that given day, but really talks about the long-term outlook. That's how the dot plot of the expected Fed funds rate gets adjusted. It's where markets start to reprice in the futures for the Fed funds rate and other yield generating assets like bonds and treasuries. So this is really going to be an important meeting, I think, going into the close of the year. We've had the Fed keeping rates flat here for multiple months to nearly a year now. And the question is whether or not the Fed is going to continue moving upwards in the future, if it's continuing to price in higher rates and for longer, or if it's going to start considering rate cuts in the near term, if things have started to adjust. And I think this could be a catalyst moment here, especially with Bitcoin and altcoins as well, testing towards these critical ranges of either prior support or resistance, these important ranges of price that we've seen hold some significance in the past. So this is going to be a really critical time here to keep an eye on this. Now, a lot of you might be wondering, again, where I lean on this. As you all know here, while it may not be at this exact meeting, we do believe assets are generally still in a bear market or in a no-trend scenario where they're not going to be trending to new all-time highs. I don't think we have the breadth and the amount of kind of a momentum, and most importantly here, the liquidity to actually make that happen. But let's just go ahead and take a look at some different charts here that can maybe give us some hints. Because while there are prediction markets, there's all kinds of things out there we can look at. I think looking at market prices is going to give us the most valuable information. Looking at the market data is going to give us the best visual perspective. And what things can we watch here that can help signal the future direction of things? Well, the first thing here I want to take a look at is the DXY, the dollar index. This is the US dollar index, which weights the dollar's performance against a broad range of global currencies like the euro, the Great British pound, the Australian dollar, Japanese yen, all kinds of currencies out there in the world that are world reserve currencies or leading world currencies where people flee for safety. And essentially, we can utilize the DXY here to compare the dollar's performance against other currencies. And the important thing here is that while those other currencies may hold significant weight, they may have strong economies backing them, what we've generally seen here with the DXY is that the dollar index here has continued since back in July to reaccelerate like it was from June of 2021 going into September 2022. And the reason this is happening here is because as the dollar index moves up, this means that markets are pricing higher interest rates for longer and are likely pricing in that the Federal Reserve, as we continue to move higher here in the DXY, the Federal Reserve is more likely to outpace the tightening of other central banks in the world. Essentially, dollars are going to become more scarce versus other currencies, and that's why they're starting to trade at a higher premium, the highest premium since back in November of 2022 in over a year. So we've wiped off a year of basically decrease in the dollar in just a couple of months here since back during the middle part of this summer. And we've been able to do it much swifter here to the upside. So the question is, are we essentially going to stop here and pull back, or are we going to move higher? To be honest, if I'm looking at this weekly candle structure, guys, to have multiple green weeks like this and to not even get a pullback down towards the 200-day, to hold flat here where every dip is being bought, and now we're pressing to potentially have a high weekly close here, the highest level since back in November, this is looking really strong to me. It is very rare that you're going to get in any asset or any type of financial market a green week after green week after green week for well over 12 weeks in a row and then continue to reaccelerate higher. I mean, this is a really great setup here. So this is something that has kept my eyes glued to the screen for the past few weeks. Now, some of you might be wondering here, Nick, I don't trade Forex markets. I don't plan to go long the dollar by any means. I trade or invest in Bitcoin, cryptocurrencies, and sometimes in stocks. Why is this chart relevant for me? The reason it's incredibly relevant for those of you who may be investing in risk-on assets is that it is a clear signal of the direction of Fed monetary policy. If the dollar continues to garner strength, the Fed is likely going to continue tightening and outpacing other central banks, leading in the fight against inflation. If we start to see the Dixie really start to significantly contract on a month-by-month basis over and over, we have more conviction that the Fed is likely going to start easing and stop leading in the fight against inflation against other central banks. So dollars will no longer be as scarce. The reason this is significant is because so many people out there and financial assets have different skewed perspectives here on what the Fed is going to do. And those who are more exposed to risk on assets lean a lot more in the camp that the Fed is going to pivot. They're going to save them. They're going to save these financial assets. And I don't blame you if you started investing in 2021 or 2020, or even started back in, say, 2017 or 2018, or even before that. It's been a custom over the last decade that the Fed would come in to the rescue and save financial assets. Unfortunately, though, as we have signaled on this channel, and I think the dollar index is signaling, that's not happening this time around, even if something breaks. And the reason for this is because the Federal Reserve is dealing with stagflation. They're dealing with the initial signs of a recession, a slowdown in the economy, but they're still dealing with the effects of inflation sitting well above 3.5 to 3.7% on an annualized basis. They need to get that not only down to 2%, as we've talked about here on this channel, they need to get that below 2%. They need to crater it down likely for a month or two towards deflationary territory. So we can essentially really get inflation out of the picture, get rid of the psychological effects on financial assets and the cost of goods and services that inflation can have, and set a tone that we're going to have a short-term wave of pain rather than kick the can down the road and then have to have a depression down the line, which is much more painful. I think the Federal Reserve, albeit they could have been more aggressive in this over the past few months and not kind of paused and waited for the economic data, they're at least still focused in the right direction. And I understand it's not a popular opinion to say that the Fed is doing their job or doing things right, but I think the Federal Reserve is at least focused more in the right camp here. And the reason for this is because, again, if we don't deal with it now, it's going to get worse later. And that is going to have an effect on financial markets. We can start to see this kind of contractionary effect playing out across the board in financial assets. I'll give you some examples here. We can just take a look here at what's going on in the airline stocks. Airlines are great to measure because they give us a good gauge of when the times are good and when times are difficult. It tends to be that airline stocks do good during two periods of time. Generally speaking, when you have two factors going on, when you have essentially strong consumer activity, people going on trips, traveling more often, this essentially is bringing more volume, more revenue, potential profit for airlines. And outside of that as well, when you're having lower fuel costs. So when times are good, producers are going out there, competing in the market. There's a really nice imbalance here between supply and demand. Oil is cheap, therefore jet fuel is cheap, generally speaking, and that's going to allow for airlines to boost their profit margins. You can see from 2009, right here at the bottom of the recession, really going in here to 2015 and January 2018, airline stocks were killing it. But since back in 2018, many people don't know, we were already having initial signs of a correction. We did eventually have the real flush in 2020 in many ways, but even with that, we printed a ton of money. We prevented ourselves from going into a necessary recession during that period of time in financial assets. And unfortunately, while that did provide a buoy of relief here in March of 2020 up towards the 200-week, we have time and time again faced resistance at the 200-week. We are not turning it into support, but rather resistance. And we have just recently collapsed since back in the summer from $19 for American Airlines down to $11 per share. And it looks like we're ready, just about ready to snap from this range of support at around $10. And if we do, we're entering into no man's land until $4 to a potentially $1.50 per share, historically speaking. Airline stocks can go through incredibly volatile corrections during these recessions. For example, American Airlines went from around $63 a share down to $1.50 in the last recession. Now, I'm not saying it has to be that bad, just a great kind of visual representation of what can happen on these stocks. Take a look here at JetBlue. JetBlue went from $31-ish, basically $31.50 per share, down to $3 per share, more than a 90% contraction in one pullback here from 2003 2008. Along with that as well, we can see since 2015 getting those initial signs of weakness, but really the capitulation setting in here in 2022 and 2023. We are already back down to recessionary territory for JetBlue at $3 per share from its relative highs back in 2015 at $27 a share, or where we were back in March 2021 at $21 a share. Delta Airlines, one of the strongest airlines, the few that has been relatively holding up here, as it has a strong base in the United States for domestic flights, which have held relevancy for a long period of time, and they've been able to make much better profit margins. We can see we've had 2 quarters here of double-digit pullbacks, and we are back on this range of ascending support. If that breaks, the airline industry is going to be going through some big bankruptcy and restructuring proceedings. A lot of those names are no longer going to be out there in the sphere of airlines out there. The Fed can't come in and save everyone this time around, guys, because if they do, they're going to reignite inflation. There are going to be some people who get knocked out. Now, it doesn't mean the airports go away or the airplanes disappear and that no one's going to be flying. What I mean more is that these companies are going to go bankrupt. The equity value of these companies, billions of dollars, is going to be wiped out over the next few months and the next year. And it's not just here in the airlines we're seeing weakness. We've seen it in the cruise lines, again, another kind of niche sector where you see the early stage warning signs of a recession, that the discretionary spending, right, essentially the difference, not discretionary spending, but essentially, basically people who are spending their disposable income, right? Those people are no longer spending like they used to. So think of it as if you were to think about it like a pyramid, right? It's the top of the pyramid. It's the first initial stages of a recession. And then we start to kind of trickle down here into the more fundamental sectors where we see weaker earnings reports and we see people spending less in the economy, cutting corners on expenditures wherever they can. A great example of this is also tracking the essential profitability and the stock value of a lot of the major credit rating agencies in the United States, or essentially those companies that are rating credit scores for various people like Equifax, TransUnion, all kinds of different players here in the space that are essentially determining creditworthiness. Now, why is it important here to be tracking the consumer credit rating agencies like Equifax, TransUnion? Why is this so important that we watch these? Well, the reason it's important is because they make money by essentially offering you free credit ratings, and from there connecting or brokering towards you different types of debt. Consumer credit cards, mortgages, auto loans. Depending on your credit score, they can pitch you on various different types of financial products that essentially all come in the form of debt that allow you to borrow money today that you pay down in the future, to allow for purchases here today that you feel are necessities or things that you want. And while this is a great thing in many ways, it's also a great indicator here of letting us know whether or not people are borrowing in the economy or that banks are lending. And the key thing that I want to draw your attention towards is that while we've been recovering since October of 2022, here towards June of 2023, from around $147 for Equifax's share price towards $243, we've pulled back down in a matter of just 4 months here, back down to $169 per share. So what's going on here? Well, we're starting to see some earnings reports from these different consumer credit rating agencies that are signaling big problems out there in the world of debt and credit. Essentially, a lot of people are not borrowing like they were back over the last year. They are paying down debts, or more specifically, struggling with the already existing burden of the debts that they've taken on right now. We can see here as well that Experian, one of the other large credit rating agencies, has basically cooled back down to where it was in June of 2022 in just a matter of 3 months, coming from around $39 per share down here towards $30 per share, wiping out billions of dollars of value. And one of the most prominent ones here is TransUnion, coming here just back in September from $82 a share down towards $43 a share, wiping off nearly $8 billion in market capitalization for the company. This is massive stuff, guys. And it's important to note that it's not just about the share price going down. I mean, stocks have been kind of down for the past few months after a really strong rally. But why is this significant? Well, the reason it's significant is because we can utilize through ratios the performance of these credit rating agencies versus the S&P 500. And we can see that during optimistic periods of time, right, we generally see these credit rating agencies, when stocks are trending higher, generally move higher against the S&P 500. However, we've seen a stalling in the trend here, and this is an early precursor here, like it was back here in the 1998 range into the dot-com bubble. that the warning signs showcase themselves much earlier here from when we get that recession, right? So we're starting to see here about a few months to a year out that these agencies are starting to decline significantly against the S&P 500, and they've still got a ways to go here, right? So as we're declining here, this is again a forward-looking signal that we're expecting some pain here in the near future, that we should be expecting an upcoming recession. This all builds on top of what we've seen within the yield curve. If we see here with Expedian, right, it's already snapped here to its lowest level since 2009. And again, we're entering into no man's land here. So a lot of these credit rating agencies are signaling serious pain to come here. We've seen here that TransUnion, which IPO'd in 2015, has already lost all of its gains against the S&P 500. Now, of course, all these stocks are still up technically versus 2008, 2009. I mean this more as a signal here that the stocks are about to face some significant trouble. And in doing so, that as they're facing trouble, this is an early stage sign of pain to come across the board in financial markets. Even if you don't want to buy these stocks, they're a signal, an indicator, a forward-looking indicator into the state of consumer strength. And this is still in an environment here where while oil prices are definitely not where they were, say, in early 2022, they are still well elevated above the 200-week and the 200-day moving average. And even during these pullbacks here, we're not able to get a significant enough contraction that really signals that the Fed has done the job. And while oil may be more kind of sideways here for the last year, natural gas is starting to continue moving higher here over the past few months at a quite accelerated rate towards its 200-week. So we're seeing here that there are a lot of signs that the Fed still has work to do here, but there are also those initial signs that we are getting the warning signs of a 6 to 12 month window that a recession is coming. We don't know what the catalysts are going to be. We don't know exactly what's going to break, but something is coming here. And I bring it all back here to cryptocurrencies in the sense that we've got to be asking ourselves a fundamental question. Will there be the disposable income both for retail and institutional investors, but also as well for those who are looking to potentially expose themselves to a Bitcoin ETF to drive a bull market? I don't think there's going to be that huge influx of capital that many people are expecting for a Bitcoin ETF. I got to tell you guys, I really don't know, especially as we move higher in prices, if there's going to be the market buy side pressure versus the market sell side pressure to really drive prices higher and go to new all-time highs. If you're in that camp, if you're thinking that the Fed is going to easily pivot on a dime, if you're thinking that an ETF is enough, I'd say to be cautious here, guys. There's plenty of people out there who will tell you that it's an absolute game-changing opportunity. You got to get in on it. This is going to be the last great bull market here. I think going off of that narrative that, hey, this is going to be the last move here, we're all getting in on it, that sounds to me like people who, A, don't really believe what they're selling, and B, are likely going to buy in to what is very well a relief rally, not a new bull market, which is going to correct further. To put it simple, guys, there are a lot of people out there who will give you the optimistic narrative, the overtly optimistic narrative that Bitcoin, through the halving event and a future ETF, are just guaranteed to send Bitcoin to new all-time highs and to continue trending higher. Whereas I think here in this channel, we are taking things from a more kind of pragmatic viewpoint here. We're looking at forward-looking indicators for risk on or risk off nature in financial assets. And we are assuming that if we are continuing to see these weakening signs here, that we are likely going to have that weighted effect, not just hit stocks, not just the broader economy, but also cryptocurrencies as well, which are highly dependable on excess liquidity and more specifically disposable income. That additional money that you have beyond your kind of fixed expenditures where you have to spend money for food, gas, your home, the additional money that you can put in savings or park into an asset where you hope to hedge against inflation and spend it on a later date. That's the key thing that drives Bitcoin. And we don't have central bank liquidity, nor do we have excess disposable income. What we're seeing here and what we discussed today with the credit rating agencies is a clear sign of that here. It is a forward-looking indicator to let you know that over the next 6 to 12 months, we're going to have a growingly weaker consumer. And with that, it is going to be a weaker economy. Now, if you feel like being in the camp of investors and traders who can survive both in the good times, we can do really well in the good times, but also as well do pretty good in the bad times or the shaky or no trend scenario windows of time like we're in now, I would recommend you guys check out the Dash Report. It's our newsletter here on the channel. It's not only a great way to support the content we do here, as we put out a lot of free content here, 3 videos a week, but outside of that as well, You guys will get additional content like the 20-page report, which is going to drop here today. You guys will get to join us on our mid-month webinars where you guys can ask me questions. You'll get our trade alerts. You'll get access towards our exclusive blue-red indicator that allows for tracking momentum in the market across all markets through TradingView, and all types of different tools and resources like the Dash Report discussion group. And the cool thing about this is that right now into the close of the year, we've kept the pricing the same as far back as 2018 when we started the newsletter. However, guys, after nearly 5 years, we're looking to finally raise the prices on our newsletter at the start of the year. So you guys can lock in and be grandfathered into the rate of $240 a year, which is 20% off the monthly subscription, or you can even just do the $25 a month subscription and essentially lock in that rate before we raise prices later on this year. Again, at the end of the day, it's not only a great way to support the channel, but you guys can lock in and grandfather that rate so that you'll always have that rate and it won't increase when we increase rates later on next year. So that's it for today's report, guys. If you're interested in checking out the Dash report, you guys can find it at the link down below in the description, and it gives some details on all the stuff that comes with it. But outside of those, well, above all, guys, if you like the video, consider dropping a like. It's a great way to support what we do here, and I'm looking forward to chatting with you guys on Friday at 6 a.m. Eastern Standard Time. Take care, everyone. I'll see you all in the next video.